Hello, and welcome to my presentation about 2025 market outlook and portfolio updates. I would like to keep it really informal, but I would like to convey my sincerest thanks to all of you who are joining me to view this presentation. I know that most of you are either my followers or copyists from Etoro. However, I would like to keep this presentation a little bit more generic, such that it can benefit a wider population in YouTube. So what I'm going to do is structure this presentation in a fashion that's firstly walking through the general macroeconomic trends that we have observed in the last year and what it conveys towards an outlook for the year of 2025. And after that, I would also provide a little bit of update about how I'm planning to rebalance my portfolio. Maybe by the time you're watching this portfolio, if you are my copier, you might have seen this is already taking place. I'm recording this video on December 30th. Hopefully, I can be able to edit it and release it in 2 or 3 days. But then the rebalancing is probably going to happen between the period of December 30 and the 1st of January. Yes, okay, let's dive in. Disclaimer. Of course, the content that I'm going to provide you in this presentation, I did my due diligence to present as much as possible an accurate results. However, I would still advise that if you're following the presentation, please do your own due diligence. Do not take my words for granted. Given that I have tried my best. Okay. Who am I? Of course, most of you had been directed to this content either through my Etoro popular investment profile. So that is who I am at the moment. I'm a popular investor in Etoro. I am trading or investing under the username of Mars. Don't ask me why it's Mars. It's spelled in a reverse direction. It's my pet name, Sriram. I have a PhD in physics. I live in Netherlands, and I've been a quantitative analyst for almost 5 years in one of the leading Dutch bank. If you are new from eToro, and if you're planning to copy me in the future, and if you're following me or have added me into one of the watch list, my recommendation for you is to start with a copy amount of at least $1,000. Why is this important? Because if you copy it for any lesser than that, it could still happen that some of the trades that I have open are very tiny in your $1,000 portfolio. Say if I have 1% and a 1% of $1,000 would be just $10, and that trade cannot be opened, right? So then your portfolio would be deviating a little bit. But just start with any amount that you feel comfortable with, but my recommended amount would be to start at least $1,000, and then every month in a disciplined fashion invest at least $100 per month. So my investment timeline is to look really long term for either 5 years, 10 years, or 15 years. Why do I do this? This is my core investment platform, and I invest most of the money for my own retirement. This is one of the platform or only platform that I use for my own wealth building. So any investment that I make will reflect that ideology or mindset. So I won't be trading or using a leverage because this is my own life savings. And which is why you should also feel comfortable to copying me or investing me, because you know that whatever I do within this platform is very risk diligent. And given my background as an analyst in the field of credit analytics, I do know quite a bit in terms of the financial and the technical aspects of risk management. So I do also use those principles behind making my decisions, and of course also consider the macroeconomic movements. Okay, and at the moment I have almost around 176 copiers by the time I was taking this video, which is really nice, and mostly thanks to all of your trust. And if you are a copier, I really appreciate you being here And I hope that you copied me in the year of 2023 or 2024 and landed with a handsome return of around 70 to 80% per year. If not, if you had just copied me, just stay along for 15 years, and we are very sure that we would have similar years in the future as well. Okay, let's start with the macro outlook for 2025. When I speak or think about macroeconomy as a whole, the first thing that always comes to my mind is inflation and the interest rate from the central banks. These two are really closely interlinked to each other and plays a significant role in the valuation of most of the equities that lies under the stock market, and sometimes even outside the stock markets, be it your house or some kind of an asset, even a milk carton that you buy in a supermarket. To provide a short overview, how this really relates to the price of assets when the inflation is high, usually the central banks tends to reduce this inflation by providing or keeping the interest rate at a really high rate. When this happens, eventually all the discounted metrics of valuation goes, discounted cash flows become less useful in the future years. So the money now becomes more important than money in future, which means that most of the growth related stocks, which are expected to earn most of their cash downstream in the 5 to 10 years, gets valued less. This is why we look at the inflation trends in a sense to understand how it will affect the stocks that are present in our portfolio or in general any portfolio, right? Before I say so much that confuses you, the short message is that if inflation is high, usually the interest rates are also maintained high to bring the inflation down, which means money now is more worth than money later. Very good for stocks, cyclical stocks, but very bad for growth stocks, which are expected to earn money in the future. Okay, all right. Given this information, I would like for you to look into the presentation and observe the charts and try to collect as much as information as I walk through them. So what you see is the inflation figures for the past 5 years on the left part of this presentation. On the bottom, you also see how the employment rate was correlated to the inflation rate in the United States and also in the European Union. So what we observe is that during Corona, there was a slight period of fall in the inflation rates, but then we started seeing higher inflation because of stimulus packages from the federal government. This happened not just in Europe, but also in the United States. And during 2022, we saw that this led to an extreme inflation, and we all felt it even in supermarkets and also in other things like the housing prices, for example, in Netherlands. People were able to book really cheap loans, which led to really high asset prices. But this came to a point where this needs to be controlled, and central banks all across the world started taking action, and they started raising the interest rates. And we saw 2 more years of gradual decay of this inflation towards a more acceptable level of 2% or 3%. Which is why you see this slight peak and then a slow drawdown towards the end of June, July of 2023 and 2024. But what I wanted to really show you is the zoomed in picture for the year of 2024. Let's just focus country by country here. If we look at the United States picture from November 2023 till the November 2024, the last trailing 1 year of periods, we see that the inflation comes down, have come down, but not dramatically. While the federal government has maintained this interest rate and did have a few rate cuts in the last year, but we see that the inflation is a bit sticky. in the last month or the last 2 months, it's also scary to look at the picture. We see a slight increase in core inflation, like we saw in the first month of 2024. And this should be read together with the unemployment rate for the United States, where we also see there's a slight peak. And what is even more worrying is that we see a similar peak in unemployment rates for the month of November. This is also why we saw the jobs report for July leading to a huge sell-off in the market. But we will get to that later. But one thing I want you to understand at the point is that these trends do matter on the prices of the assets. Even though it's not an worrying picture, we are in a controlled state with 2 to 3% of inflation all across the world. Only exception is the Netherlands, where it looks like the inflation is climbing slowly back up to 4%. Yeah, but then European Union has more stable job market, and then you don't see quite great movement in terms of unemployment rates. All right, going ahead, what is also really important is to look at the trends of importance. The last 2 years or 3 years has been mostly about OpenAI and the release of ChatGPT, artificial intelligence, and everybody wanted to get into this field. Starting from supermarket chains to fancy data analytics companies, everybody is now an artificial intelligence company. And recently, there's also a lot of interest about quantum computing and how it would probably be the next best technological breakthrough. And maybe it will be, but what we also observe in the trends is that the interest in the artificial intelligence started peaking, started rising around 2022. And lately, what is more interesting to observe is the last part, where we see that there is a sudden drop in the interest or in the trends of artificial intelligence. This can also be seen the same with cryptos, which is kind of a bit something to keep in the back of your minds. Maybe this is just a holiday dip during the December, because we also see a drastic dip in 2023 and again a dip during 2022, and then a sudden spike back again. And we do hope that same happens in 2025 when everybody is back from vacation. But if not, this could be the point where people do realize that artificial intelligence and the companies that are related to AI are a bit overvalued at the moment. But you never know. The next thing I want to look at is how the emotions were in the trailing 12 months period. What you see here is a chart, a 1-year chart of S&P 500, and I would like to overlay against this, this chart, the fear index, right? So, and let me do that. So when we look at the fear index, we do see there are a few times where the market went into close to an extreme fear mode, partially due to a gradual tech sell-off that happened during the month of April. And then the July jobs report, as we discussed before, started a huge sell-off in the market. There were worries about a recession, upcoming recession in a few months later, that also led to a huge sell-off. And lately, during the last few days of December, trading days of 2024, there was also a decision from the federal government regarding the number of rate cuts to be expected in the year of 2025. This was outside the expectation, which also led towards a little bit of sell-off in the gradual market. What I would like to stress here is that whenever there is an extreme fear, we do see a drawdown in the S&P 500 of around 5% or 3%, depending on the intensity of the news, what is driving this fear. Uh, Going ahead, what is a best asset when such fear happens? I was thinking quite a lot. What could be an asset that we could own at this point whenever there is an extreme fear, there is a negative correlation to it. And then it struck me that it is always gold. So what I did is to see if gold had a negative correlation with the market fear index, uh, which turned surprisingly to my assumption that it is actually true that gold do work as an hedge. Uh, Gold had similar performance in the last year compared to the overall market of S&P 500. And we also do see that whenever there is a severe sell-off, the gold actually either remains stable or there was a slight move towards the positive side. For example, if you see the sell-off during August, the gold was actually having 2 to 3% upsides during the similar period. Even during the December sell-off, the gold remained surprisingly constant, um, which is quite good if you want to formulate it as a strategy. It's always nice to hold a few of your portfolio investment in gold, and when something unexpected happens, this provides you with a gunpowder or a powder to buy something new, right? So you won't be closing off positions under losses. So you could, in principle, sell gold during excessive fear times and invest into equities. But of course, this could be a good hedge. That's basically what you have to take from this slide. One thing I also wanted to check is whether Bitcoin can be used as a hedge, because technically speaking, Bitcoin was proposed as an alternative towards something against money, in essence, currencies, right? So the general currencies, the centralized currencies like US dollars or European currencies, euros, they can be controlled by the central bank, but Bitcoin is proposed as something that is decentralized, in a sense that nobody can do a quantitative easing or do some kind of a monetary policy in such a way that can tweak the prices of assets, etc. In that sense, Bitcoin should work similar to gold, and that's why you also do have the similar terminologies when it comes to mining Bitcoins, like mining gold. It comes with a constant quantity of assets. Uh, so in theory, Bitcoin should work as a hedge during fear times. But what I did see, to my surprise again, is that that is not the case. Because Bitcoins as a hedge, they do not work. To my surprise, I found that it's not possible, and then the Bitcoin had sometimes even drastic drawdowns compared to S&P 500 during the sell-offs based on excessive fear. And we see it every time that whenever there is a fear, there is also a drawdown in the Bitcoin valuations. But of course, Bitcoin is a more volatile asset, and it has provided a much better return, probably compensating for the risk that people took in investing in the Bitcoin. I think the year-to-date return for Bitcoin was around 100%. But one thing for sure is that Bitcoin is not a hedge for turbulent times, or at least in the last year, it hasn't been a good hedge. And of course, past performance is never an indicator for the future. Depending on which kind of sell-off is being happening, one asset can be a better hedge compared to another. But in a generic sense, it cannot be claimed that Bitcoin will always be a hedge for a broader market sell-off. Yeah, so that brings to the closure of the first part, which is the macroeconomic outlook. Given all this, what do I think will happen for the year of 2025? We had really 2 good years of positive returns in a generic markets. From S&P 500, we had around 26% return year to date for the 2024, and 2023 was also a good year with a really double-digit return. I don't know it from top of my mind, which also says quite a lot about the valuation of assets. At the moment, I personally feel that market has a high expectation going ahead into 2025. Most of the companies are expected to either grow at a higher rate, which they cannot, or provide a profit at a level which they cannot, or provide a story or a guidance at a level which will be really close to impossible. And what will happen if these companies were unable to meet these expectations? Could there be a drawdown, or could there be a sell-off, or could there be a temporary sell-off, immediate purchase of properties and assets? This is something that we have to consider. So for me, at least, 2025 is going to be an year of extreme expectations across the markets, and everything is expected to perform at a really top level. Given this in mind, what I did was generate a strategy for the year of 2025. I will explain the strategy based on a 10K portfolio, hypothetical 10K portfolio, and what is, in my opinion, a best approach towards the year of 2025. I divided my investments into 4 different components. I would like to invest a part of it into what I call as multi-baggers, or investments that have a potential to generate more than 100% return in a year. And then the second group goes towards market leaders, or how I define them as assets or companies that are really crucial for day-to-day operation for any person or any job. For example, Alphabet, Google, Chrome, YouTube, search, and without which nobody can perform any of their day-to-day activities. Google Maps. It would be literally impossible to imagine a world today without Google. Amazon, similar kind of story. Both of them do have quite a good infrastructure, and they were the core cloud offerings in terms of companies to operate. So in that sense, market leaders for me means companies that are really vital, just not just for business, but also for regular consumers. And of course, this list could extend to other companies like Apple, Meta, Nvidia, Tesla, everything, right? So, but then Tesla belongs to multi-bagger. Other companies like Broadcom, but they were not in my list. The primary reason is I would like to keep my strategy or my investments close to what I already know about. So for me, at least, learning about something completely new like Broadcom is too much as an individual investor. It says so. Some companies not being in my list says nothing about those companies' performance. It just means that I'm unaware about their business. So I would like to maybe in future venture towards that path, but for now they are not in my list. And the third biggest chunk of my portfolio, I would like to keep it in what I call basics. So whatever comes under my ignorance, I like to cover it using my basic portfolio. So for example, if I'm not exposed to Apple, I would like to be exposed to Apple using S&P 500, which comprises of the broader US equities and all the companies. So what I did is also include some treasury bonds, and the reason behind the inclusion of treasury bonds links back to our discussion in the inflation. We do expect in future the interest rates to fall down and the inflation to come down. If both of these happen, then the bond prices are expected to rise because the yields will go down. Um, Yield is inversely related to the price of the bonds. And for now, to be honest, this is a quite good investment, which gives a 4.2% dividends or coupons. And then I would like to consider gold to be included in the portfolio, which I haven't done so far in my investment career. The reason is that the more and more I understand how gold is correlated towards the general market, it sounds like a good investment to hold in your portfolio just to counteract the volatility during recession times or during fearful times where everybody is selling off. So, given this division on a 10K portfolio, I would still like to go for a dreaming situation where there is a bigger allocation towards the multi-baggers, the Palantirs, Teslas, and the CRISPRs, and 20% allocation towards the market leaders, and another 20% towards the basics. Uh, Especially because I'm considering the next year to be a cautious year where the expectations are quite high on companies. Uh, my assumption is that most companies would find it difficult to meet these expectations, and this can disappoint the market. When this happens, there is quite a high potential for a sell-off during earnings or during any of the updates from the companies. And if these sell-offs are not warranted for a good company, this could be an excellent opportunity to DCA into or to enter into the position. And this is quite essential to hold quite a big chunk of cash in your portfolio uh, to await such opportunities in the next year. And this is why I'm holding a 20% cash in the bigger allocation strategy. Right. Uh, Given we arrived at this stage, I would like to move towards the next section where I'm going to discuss a little bit about how to allocate what percentage of money towards each one of these individual equities within these sub portfolios. Right. So to do that, uh, I did look into something called modern portfolio theory based on Markowitz optimization algorithms. I did have my own algorithm that looked into the modern portfolio theory. So given a list of stocks and given a list of initial allocation, my algorithm was able to generate an optimal weight, which reduces the ratio between the return and the risk and provides an allocation which is the best, which contains the best Sharpe ratio. Uh, I would not like to go in depth regarding what is happening in the background of modern portfolio theory, but I would like for you to understand that modern portfolio theory looks at two particular assets and sees if they are correlated. And if they are correlated one to one, it picks the asset with the best return. For example, let's say if Google is correlated with Amazon because they sell or operate in similar kind of market environments, and if Google has a better return and less volatility, it's more beneficial to allocate a huge amount to Google compared to Amazon. And then the output of the modern portfolio theory would be a higher weightage towards Google and a lesser weightage towards Amazon. And if we did this for a portfolio of 8 stocks, this is the percentage of allocation that I received back from my algorithm. So based on the modern portfolio theory, we got an allocation or the optimal allocation for our 10K portfolio, which looked something like this. So $2,000 goes into cash because we wanted to hold 20% of our holdings as cash. And the next highest allocation was to Palantir, which held about 24% or $2,300. And the lowest allocation was to Treasury bills, which is TLT, which hold 4% of allocation with $400. Right. The next ideal step is to see what is our current allocation towards these equities and see how much we have to decrease or increase our position per equity. And does it really make sense in a generic context, right? So because one thing I want to advise you at this moment is that modern portfolio theory is looking at past performance, returns, and volatilities in the last year or last 20 years, because I ran this calculations for the maximum period possible, and it was run based on a daily return basis. So the returns were calculated on a daily basis, and then the volatilities were calculated on a daily basis, and the correlation matrix was calculated on a daily history. And then the allocation was estimated for a Sharpe ratio that was calculated on an annual return and an annual volatility, right? So the ideal step is to see how is this current allocation look like, and how different is it from the proposed optimal allocation, and does it make sense, right? So how do we know if it actually makes sense when, for example, the optimal allocation says to decrease a certain equities allocation percentage, right? So then we look into the, for example, macroeconomic condition, the stock charts, the price to sales, fundamentals, book values, enterprise values, uh, so and so. That is what we are going to present in the next slide. So let me move towards it. Right. So looking at this table, so what we do have at the moment is, for example, S&P 500. Excuse me. We have 13% allocation, and we have no exposure to golds, and we do have 1% exposure to treasury bonds, and a really high percentage of exposure to Palantir. And the reason for this is that Palantir grew quite significantly in the last 2 years. Um, I remember that I was a dollar cost averaging at around 20 to $7 back to $20 at an average price of around 14 $15. And at the moment, as we are recording, the stock price is at about $77 $76 per share. This gave us a return of around 400%, and Palantir grew to be the most be the largest allocation of our portfolio. And Tesla is around 8% of our current allocation, and we do hold 12% as a cash. There was also 1% allocation towards CRISPR therapeutics, hoping for a miracle to happen in the genetic field. And then if it happens through CRISPR, which is a huge probabilities are so low, but could still happen. But then we would like to keep it in our current allocation, right? But and this is also how the current allocation looks in terms of dollar amounts for a 10K portfolio. And this is the expected allocation based on modern portfolio theory that we just saw in the previous slide, right? Does it make sense? Because, for example, just based on modern portfolio theory, we have to go from a 13% allocation towards a 10% allocation. In terms of amount, this would be a 26% decrease in our holdings for S&P 500. And based on extensive fundamental analysis, after breaking my head for almost 2 or 3 days, looking at all the charts, all the macroeconomic data, I came to a conclusion that it is not necessary to decrease the exposure to S&P 500s. The reason is that we don't really see a reason. Of course, the market is a bit overvalued at the moment, but just by staying underexposed to S&P 500, we do not gain a lot. And there is no other opportunity for the cash that we would get by selling off S&P 500, except for raising our tax amount during the end of the year. So I decided not to cut off the exposure to S&P 500. And going through the gold, I do agree with the modern portfolio theory analysis. Gold provides an excellent counter correlated asset towards the rest of the portfolio, like Palantir, Tesla, Amazon, and Google. So we will initiate a 7% holding for gold. And how do we do that? Uh, First, we will sell off a bit of Palantir shares. So we will cut off, for example, 45% of our Palantir holdings. So we will go, for example, from $4,300 exposure to $2,300 exposure to Palantir, and take the proceeds from such transaction and initiate a position in gold. We will do both of these immediately. The reason we are underexposing ourselves to Palantir is, again, linking back to the overall presentation. There is reducing trend in artificial intelligence. It looks more like the expectation is on Palantir is too high at the moment, with a price to sales of around. Uh, to be honest, I don't even remember what is the price to sales, but I think it was around more than 200 as we record this video. The industry standard for price to sales is around 60, 70, or maybe sometimes even close to 25 for companies that are really undervalued. But to be honest, at this point, it did feel like we had a good run with Palantir, with a 400% return over the last 2 years. And it feels rewarding to book some profits out of Palantir. This is exactly what I'm going to do. So we will underexpose our Palantir portfolio a little bit. But that being said, we still hold around 25%, which is a quarter of our portfolio in Palantir, and this is a significant amount to gain advantage if Palantir runs off to, let's say, another 100% in 2025, which I really don't hope happens. Primarily because it's healthy to have a gradual build-up that is based on fundamentals rather than a frothy high valuation, and then nothing makes sense. Right. Okay. Going back towards treasury bills, we do have some exposure, but I do agree that having a little bit more exposure to the treasury bills will eventually benefit us, because interest rates are expected to fall in future, which means the treasury bills can raise in value, and holding treasury bills produces really no risk at all. It's one of the greatest investments you could have, with a constant coupon paying every month. So there will be some coupons because of such investments. Another thing that is going to happen in the market leaders portfolio is that, according to the modern portfolio theory, we have to increase our holdings for Google a little bit and decrease our exposure to Amazon. I do agree that Amazon and Google are both seemingly undervalued according to mega caps. However, if looking at the past history says that Amazon is a bit more volatile compared to Google, it do make sense to underexpose to Amazon and then overexpose to Google. So we will also accept this choice, and we will raise our holdings for Google a little bit and then underexpose ourselves. So the proceeds of this transaction will partially land up in buying more Google shares, and then the rest goes towards the cash holding. And comes the biggest chunk, the Tesla, where it is proposed to increase the Tesla holdings by 100%. So according to the calculations, the best portfolio with the highest Sharpe ratio is the one that has twice as much as Tesla shares as what we currently have. So 8% to 16%. I do agree to that. Tesla is a wonderful company to hold, but we won't do this as a one-off bulk investment. So this will be a gradual investment into Tesla holdings. The reason is that we do see that the stock price is currently at an all-time high, and instead of going into a lump time, one-time purchase of Tesla shares, I think it would be beneficial for us to slowly dollar cost average into the next 3 or 4 month periods, where observing the first quarter can be beneficial in deciding further whether if it makes sense, because of course there is Optimus, there is a lot of robotics, cyber trucks, robot taxis, all the nice news, but these are all expectations at the moment, and any failure to meet these expectations could result in a negative way in the stock price, and we would really like to have a portfolio that does not have a huge drawdown for the upcoming year. So we would increase our Tesla holdings, but then keep it gradual. So yeah, it will remain in our cash pile for now, waiting for the opportunity to enter and increase our exposure to Tesla. Finally, CRISPR. The analysis said to completely remove this from our list because it doesn't add any value, because it has been a decreasing trend. The return on CRISPR has been on average negative for the last so many years. So it does make sense. Modern portfolio theory says to completely get rid of this from our portfolios, but I would like to keep it in with a 1% exposure. See, yeah, it's like a, what do you call it? It's like a jackpot. If it wins, maybe we get 100% return on a $52. But yeah, to be honest, I don't see at this point getting rid of this amount. Just I would like to keep it in our portfolio to see how, as a tracker for genomics and how it performs in the next few years. Right. Uh, Coming towards, okay, one final thing is that after we make all this rebalancing, uh, I don't know if I have a presentation slide for it. What would be the Sharpe ratio for our portfolio that is after adjusted? Uh, Let me first erase this thing and then get the pen again so I remember it from top of my mind. So the rebalanced portfolio would have a expected return. Uh, yeah, I will just call it R bar equals 55%, and a volatility sigma of around 60%. This is for, sorry, I think 60% is too much. I don't think it's 60%. And that was unoptimized. The volatility, expected volatility is 32% for the whole year, which gives us a Sharpe ratio of around 1.6 somewhere. So a Sharpe ratio above 1, between 2 is already a good risk-based return. And normally, if you can find a portfolio which is more than 2 of Sharpe ratio, that's really an excellent portfolio. It's usually tough to find as well. All right. So what does it mean? What do these numbers actually mean? The expected return of 55% and a standard deviation of 32 or a volatility of 32 means nothing. It says that you can, on average, expect a 55% return if you hold this portfolio for, let's say, 200 years and everything worked like what it has worked in the past 20 years, right? But one thing that these numbers help you to understand is something called value at risk. Value at risk can be calculated using a simple formula that is mean minus approximately 2.3 times standard deviation. times the value of the portfolio. So in this case, 10,000 is the value at risk for a 99% of the times. So what does it mean? So for example, if we plug 55% instead of the mu and then 32% instead of the 2.3, approximately we would get 50, around, let's say 2.2 times instead of 2.5 times. So it will be minus 64 times 10K, around minus 9% of 10K. So the value at risk for our portfolio for the next year is that $900. So yeah, sorry that it is not already present in the slide. I took a time to derive this a little bit, but the idea behind the value at risk is very simple. So if we let it out play for 1 year, there is a 99% chance that the drawdown in our portfolio will not be more than $900. Um, this is what the calculations say based on past historical returns and volatility. Will it be the case? We don't know. But there is a chance, and that's basically what we would try to optimize. Nobody can say whether Palantir would be existing in business tomorrow. If that happens, we would immediately lose $2,300 if it goes bankrupt. Then these calculations do not make sense. But that would be an extreme tail event. So what we try to calculate is on an normal basis, 99% of the time, the portfolio should not draw down more than $900. Right. At the risk of not saying too much to lose your attention, I would stop at this point and then go towards the next slide, where I would like to discuss a little bit about our performance in 2024 and how it compares to top investors like Jim Simmons, George Soros, Peter Lynch, Warren Buffett. You see that Jim Simmons has one of the highest annualized return of around 40%. Buffett has 21% annualized return, but and the numbers are sometimes misleading. Buffett has around 50 years of investment career, and Jim Simmons had maybe around 10, 20 years. But yeah, of course, the idea of this slide is to not compare my performance against these top investors, but to say or to take inspiration from them and then see how we relate to their performance. I'm quite happy with what we have achieved in the last 5 years. We have never had really crazy drawdowns. We have always tracked very close to the broader market, and when opportunities arise, we even outperformed the market in the last 2 years with a 5-year return of around 200% at 250%. At the time of making the screenshot, maybe 2 days ago, at an annualized return rate of 22%. To me, this is quite a good achievement, and we are on track towards getting the return that we need for the risk that we are taking. And this is quite nice to see. And ranking with the Netherlands, it's also nice to see that I was featured as in the Discover profile of Etoro a few times. Leading to quite a good number of copiers. In the last few months, we went from around 5 or 6 copiers to around a whopping 173 copiers. And by the time of recording this, the numbers changed to even 180. It's quite nice to see that so many people trust me in this journey, and I would do my best to make sure that we get the best returns for the risks that we undertake. So thanks again, guys, for copying me and putting your trust on me. One thing to mention is the last few months we never saw a red. So in our closing monthly close prices, it's a bit scary to think about. Maybe it feels and really weird to have a month where we are ending up in a negative red return, but hoping to not have it at all. Maybe the 8 month goes towards 20 months in the next year. Bringing to the end of our presentation, really thanks for if you have watched it so far till the end, really appreciate it. And if you like the content and if you got some value out of it, please leave a like and then subscribe to the channel to stay up to date on what follows. And if you really like to connect to me, please follow me on Twitter, and my Twitter handle is roalphamu. Um, what else? Thanks, and have a happy new year, guys. And I really wish that 2025 brings you a prosperous and a lot of wealth and a lot of good health. Stay happy and see you around. Don't forget to comment your thoughts in the video. Thank you. Bye bye.